Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Beijing Enterprises Holdings Limited annual report. Beijing Enterprises Holdings Limited is a diversified conglomerate with a wide range of businesses and services across various sectors. At its core, the company operates through four main segments: natural gas, water, environment, and beer. The natural gas segment involves the storage, transmission, and sales of natural gas, as well as the construction and management of city gas pipelines. This includes providing gas for vehicles and vessels, operating refueling stations, and developing distributed energy solutions. Additionally, the company engages in LPG development, natural gas trading, and value-added services. The water segment provides urban water services and manages water environments, ensuring a clean and sustainable supply of water to communities. The environment segment focuses on waste management, including household waste incineration, hazardous and medical waste treatment, sludge treatment, and waste collection and transportation. Lastly, the company's beer segment involves the production and sale of beer products, catering to local and international markets. With a presence in mainland China, Germany, and other countries, Beijing Enterprises Holdings Limited has established itself as a significant player in various industries, leveraging its expertise and resources to drive growth and innovation across its diverse portfolio of businesses and services. Beijing Enterprises Holdings Limited maintains a market capitalization of $39 billion, broadly in line with the industry peer group. Beijing Enterprises Holdings Limited trades at a lower price-to-earnings ratio of 7 times and a higher price-to-book ratio of 0.38 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced, even though it is trading at a higher price-to-book value than it peers. We will need to evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap, and if it would be better to be investing in its peers than Beijing Enterprises Holdings Limited itself. The leverage on the balance sheet appears elevated, with liabilities of 53% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets in equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 5%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified across various segments and regions. For revenue growth, key drivers include the expansion into new markets by Beijing Gas, breakthroughs in domestic third-party LNG resource capacity, and the rapid growth of mid to high-end products at Yanjing Brewery. Additionally, companies such as BE Water and EEW GmbH have seen growth due to improved operating quality and hedging against energy price volatility. In terms of specific business segments, the LNG business has experienced significant growth, driven by factors such as optimizing resource pools for international trade and deepening tolling cooperation with oil companies. The natural gas transmission business has also contributed to revenue growth, with stable business stability contributing to stable investment income. On the other hand, revenue decline is primarily attributed to the water operations segment, which saw a 6.96% decrease in revenue due to lower contributions from construction and technology segments. The VCNG of Rosneft business also experienced a significant decline of 33.1%, resulting from reductions in oil sales volume and price. Regionally, China has seen a revenue growth rate of 5.8%, while Germany has experienced a growth rate of 5.6%. In contrast, revenue declined by 14.1% elsewhere. Overall, the drivers of revenue growth or decline are complex and multifaceted, influenced by various factors such as market expansion, operational efficiency, and regional performance. The company's net income saw a significant increase of 3.8% in the recent period, reaching RMB 5.056 billion. This growth can be attributed to various factors that contributed to improved profit margins across different operations. One key reason was the efficient resale of resources, which helped optimize costs and boost profitability. Furthermore, the company's focus on operation quality improvement also played a crucial role in enhancing profit margins. By streamlining processes and eliminating inefficiencies, the company was able to reduce waste and maximize returns. Additionally, the company's decision to hedge against energy price volatility proved to be a wise move, as it helped mitigate potential losses and maintain stable profitability. The company's product mix optimization also had a positive impact on profit margins. By diversifying its offerings and focusing on high-margin products, the company was able to increase revenue while minimizing costs. Overall, these strategic initiatives combined to drive significant growth in net income and improved profit margins, positioning the company for continued success in the future. The company's financial performance indicates a significant achievement in its ability to generate cash from its core operations. One of the key indicators of this success is the generation of positive operating cash flow. This means that the company is able to produce more cash than it consumes, allowing it to invest in growth initiatives, pay off debts, and reward shareholders. The evidence supporting this conclusion can be found on pages 2, 27, and 38 of the report. These specific references demonstrate a clear trend of positive operating cash flow, which is a crucial metric for evaluating a company's financial health. This achievement suggests that the company has effectively managed its resources, optimized its operations, and made strategic decisions to drive growth and profitability. Overall, the generation of positive operating cash flow is a testament to the company's financial discipline and its ability to sustain long-term success. The company's debt level has undergone significant changes in the past period. Notably, total borrowings have increased to RMB 78.946 billion, a substantial rise compared to previous levels. However, this increase is largely driven by an 8.3% growth in bank and other borrowings, which rose by RMB 7.327 billion. In contrast, guaranteed bonds and notes saw a significant decline of 42.9%, resulting in a decrease of RMB 7.287 billion. On the other hand, interest expenses have decreased significantly, with a reduction of RMB 100 million compared to last year. This downward trend is also reflected in the total interest expenses, which fell from RMB 1,583,667 to RMB 1,300,908. Overall, while the company's debt level has increased, its interest expenses have seen a notable decrease, indicating a potential shift in the company's financial strategy or market conditions. The company's performance across various segments has been mixed. On the positive side, the environmental operation and brewery operation have shown significant growth in their profits from operating activities. The environmental operation saw a substantial increase of $262,314 between page 15 and page 16, while the brewery operation reported a profit of $1,586,177 on page 16. In contrast, the water operation has been a poor performer, failing to report any profit from operating activities in both pages 15 and 16. The gas operation also showed a decline in its profit from operating activities between page 15 and page 16, reporting only $1,438,045 on page 16. Overall, these results indicate that the company needs to focus on improving the performance of its water and gas operations to achieve better overall results. Management is optimistic about the company's future prospects due to national plans for economic growth. The company will focus on upgrading its core businesses while also investing in emerging sectors, particularly green and low-carbon development. This strategic approach aims to create new revenue streams and establish the company as a leading provider of integrated urban operation services within the next 5 years. There is no significant activity to report on acquisitions and divestitures. The company has not made any notable purchases or sales of assets, businesses, or subsidiaries during the period under review. This indicates a stable and conservative approach to business expansion and restructuring. The company has a history of paying dividends to its shareholders. In the past year, the total dividend payout was $62 per share, consisting of an interim dividend of HK$0.85 per share and a final dividend of HK$0.77 per share. This demonstrates the company's commitment to returning value to its investors through regular dividend payments. That concludes the financial summary for Beijing Enterprises Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.